Hello, Money Multipliers. Welcome back to another episode of the Money Multiplier Podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? So I just got back home from Santa Barbara, California. I was there with the entire team. So actually 11 of the Money Multiplier mentors were out there on this trip. So it was really cool to get with everybody, have a team meeting in person, because everybody on the team, we're just all across the country. So it's very rare that we're all in one setting that we can really get together, collaborate, brainstorm, talk about new ideas, and just keep pushing forward better and better for y'all. I guess I just want to express my gratitude as well to all of my listeners, my clients. Now up to date, we're serving 13,000 plus clients all across the United States. And it's just really, really cool to help y'all explore the journey of how you can really become your own bankers, have that financial liberty and justice that we deserve being here in America. So I'm proud of y'all if nobody told you today, and I'm happy that you're all here. Also, I know I've been talking about it a lot. So if you want to attend our live 3-day mastermind, I do these every single year. Now, I may be a little biased, but honestly, I think this is going to be like the best one yet. Because y'all, like the first time I ever had this idea to do masterminds was back in 2019. So when I came aboard the business, it was 2018. And so prior to that, Dad actually hosted one in 2017 in Mexico. So for all of my OGs, y'all remember that Mexico mastermind. That was really, really cool. Dad and my mom put that on together. So ever since then, I've been kind of carrying that legacy on just to help serve y'all better and better. I know we post out a lot of education and free content on the YouTube channels, the 6 live webinars that we do every single week. And y'all, if you didn't know, go to our website, themoneymultiplier.com. Underneath the resources tab, you'll find the events page, and that's where we post up all of the webinars that we do, plus any live events coming up around the country as well. So I am traveling a lot. Literally tomorrow, going to the Bahamas for a week. That's another business trip, but then also we extended it for some family time. My younger brother is actually coming with me on that trip, so that'll be very fun. We're going to hop in the airplane tomorrow around like 1:15. And Robin is our pilot, so he'll fly us down to the Bahamas. And it's really nice. It's only 2 hours, not even 2 hours. I think it's like an hour and a half or so flight from Port Orange, Florida to the Bahamas. And so we'll be out there for a week. And then I'll come home. Wednesday, we got to go to Ohio. That's where we'll do one event, Dad and I. And then on the next day, Thursday, we'll be in Nashville doing another event. And then Saturday, I'll be in Ocala, Florida, doing an event. And then after then, we got Austin, Texas, Denver, Colorado, Dallas, Texas, and then I think the first week of July, we got some breaks. So I know as this episode goes live, we'll be already done with a few of those events, but I think when this episode goes live, I'll be in Austin, Texas with Pops. So that's going to be a really cool one. It's the short-term rental forum event. This is the first time we're ever doing this one. Somebody just reached out and said, hey, I met y'all at a local RIA meetup group, and I think you guys would really be good coming over here to this Austin, Texas short-term rental event. So I want y'all to go and teach the audience about privatized banking and how do I fund my fix and flips, or how do I purchase my down payments on the properties, or just paying cash for these properties, or heck, even how do I pay my property managers or the cleaning crew if I'm doing like short-term rentals, Airbnbs, Verbos, and different things. So y'all, I guess one thing I'm just thinking about right now is that the infinite banking concept, no, this is not just for debt payoff. I get that question a lot when I go and teach this live. But this concept is for anything and everything that you're buying, financing in life, no matter if it's an investment, taxes, what we're going to talk about today, charitable giving through the policies. And I'll share a little bit about what I do in my personal life for my charitable giving. So it's just everything, anything that requires us to finance it. And what I mean by financing, y'all, there's really 3 ways that we go out and we purchase items. We either pay cash for it, we bank finance it, or we lease it, aka renting it. When I teach this live, y'all have heard my joke before. Now, there's another way you can finance it. You can steal the item or the product or the service, whatever. But we're not out there stealing stuff, right? So there's really 3 ways that we go out there and finance a purchase. And so through our banking system, why we're doing this is because now we're never losing out on the opportunity cost, or aka the interest that's forever and always able to be earned on our cash as soon as we flow it or funnel it through the policy. So I have an example here that I'm going to go through, and I will really prove this to y'all about the power of the uninterrupted compounding that's happening in the policies. Because I don't want to get cheesy on you, okay? And so for some of my listeners, you've maybe heard this quote before, but Albert Einstein, he says compound interest is the 8th wonder of the world. Those who understand it earn it, and those who don't pay it. So what do you think we've been doing all these years, being consumers to the commercial banks? We're paying them compound interest. So I want to get into charitable giving today, but just a quick reminder too, mastermind tickets are live, Nashville, Tennessee. The entire crew will be there. You can go to themoneymultiplier.com/mastermind 2024, and you can go and secure tickets that way. So I'll see everybody in Nashville. Now, as the time of this recording, it is a Sunday afternoon. The only thing on my agenda is my laundry is going right now. I did my errands. I went to the grocery store, got a whole bunch of stuff. Even went to the plant store, got some more soil. And I needed a bigger pot for one of my peace lilies. She's kind of outgrowing herself. So after this, I'm going to be doing some gardening. And then I'm also in the process of packing because we do leave tomorrow afternoon. But it's a Sunday, y'all. Just come in and learn and hang out for a second. So grab yourself a beverage or a nice snack meal. Today I picked up these sour ales. Actually, they're just at Publix. They're really, really good. It's sour mango orange passion fruit. It's brewed in Charleston, South Carolina. Edmonds Oast Brewing Company. So if you've ever heard of it, I love these sours. Definitely craft beers are like my favorites. Sour craft beers are my favorites. But then after that, I would say it's like wheat ales and then like lagers. And then I'll get into like my stouts and stuff. But those are like after meal beverages. Right? It's kind of like an espresso martini or a Irish coffee, something like that, right? So I have this today that I'm sipping on, so we can get into the fun here. So I want to talk to y'all a little bit about how I do my charitable giving through the policy. Now, I do practice something called the 1041 trust structure. I know if you guys have maybe met my tax professional at some of our past masterminds, we have done this presentation, or he's came out and have presented it live on the 1041 Trust World. And you don't got to use my tax guy. I can turn you on to other folks who are helping people implement and set up their 1041 trust structure. But what it is high level, and I'm not going to get into this today because I do have a past episode that I went deep into this. I got to go find it on there, but it's one of my past episodes. I was talking about the 1041. Now, forewarning, I'm still a student of this. I've only been practicing this for about a year and a half now. My parents have been in it for 2 years, so I'm still a very big newbie, and I'm just figuring out the ropes into this whole tax world. So when people are filling out their taxes, they are filling out a 1040 form. And when people are taking out 1040s and paying taxes on that income, it's their owner distributions out of their business, or maybe like 1099 contractors. They are completing that 1040. Now, it's been a while since I was a W-2 employee. I think the last time was literally when I was like 18 years old. So I know there's like W-2 income, and then I don't know on the W-2 side if you got to complete a 1040 form as well. Because back then when I was 18, it was literally still my mom helping me file all of my taxes. So forgive me, I'm not a tax professional giving tax advice here. But ever since I was 18 and so on, I was always 1099. And then now I do have an LLC set up for my business. And from the business, I am filing a 1040 on all of my owner distributions that I take out of my business. So that's pretty straightforward. The 1040 world, I think, is pretty straightforward. You just file taxes and pay whatever tax you have to owe to the government based on that earned income. But how I am minimizing my tax liability when it comes to like my investments, my active income, that's where my 1041 trust structure comes into play. I kind of wanted to talk just a little bit about taxes because I was actually on a call this past week and a gentleman asked me, well, Hannah, I understand the idea that money is always worth more today than what it is in the future. And if I keep putting money into like my qualified 401k IRA type of plan, I understand that I'm kicking the can down the street with the taxes that I got to pay on this money. But have we ever run the math on this? Can we run the math on if I'm not contributing to my 401k any longer, because the purpose that I'm contributing to it now is number one, saving up for retirement, but number two, I'm putting pre-tax money into it. So then when I have to go in every year and report my income, it's minimizing my income and thus my tax liability. So if I minimize my tax liability today, is it better off down the road when I got to pay the taxes on it later on? Or does it make more sense to pay the tax on the money one time only at that lowest rate possible, and then get the money into a tax-free environment where now it's growing tax-free, i.e. the policy? Because the policy will use it as retirement income, tax-free withdrawals to supplement income during those later stages of our retirement years. So no, I've never run the math on it. But I think really what it comes down to is the control of the dollar and not locking up the capital in the good dollars today. Because if you think about it, a lot of these people, a lot of y'all that I'm talking to right now, you guys go and you put money into a 401k, these IRA accounts, when you need the money today. Y'all are calling me up saying, Hannah, I got this shitload of debt and I'm just living that financial hamster wheel lifestyle and I don't know how to get out of it. And then we go and dissect where you're putting all of your money every single month, and y'all are like maxing out your 401ks, and it's like, y'all, you guys are struggling to put food on the table because you got this shitload of debt, but you're going and putting money into a 401k that involves risk. The money's into the market. Somebody else is controlling it, and there's really no guarantees besides going below zero. So it's just a different perspective. It's totally opposite to what people have been taught. People have just been taught to save, hoard the money. We're saving it for the future because we want to work the shortest amount of time possible and then just live a happy-go-lucky life. Where my mindset, and I challenge y'all to start shifting the mindset right now, is that we should be using our money today to go purchase ourselves cash flowing assets, go put the money to work into whatever investments that you like, know, and understand. So then come the time of retirement where we have this passive income stream that's going to keep flowing in no matter if we're no longer working those labor hours, having to show up 9 to 5 every single day. So it's just a totally different perspective on how we're doing it. Now, I don't know how I got off on that tangent. Yes, I got a little ADD, but today for the tax purposes and the charitable giving side of it, what I am doing is no, I don't hold any money in the markets. I don't hold any qualified plans of any sorts. It's literally just my policies. That's where I'm storing the money, my policies and my investments. So when I receive money, my active income flows to my LLC. Then what I do is that money from the LLC, it flows down to my business trust. Now, my business trust is what holds my investment assets. My investment assets is what I purchase through my business trust, and that's what it owns. So when I make my investments, I do it directly from the business trust, and then any money that I get back, that gets paid back to the business trust directly. So yes, okay, any interest that's earned on my investments, that's going to be taxable as ordinary income. But how I minimize this through the 1041 trust structure is that from my business trust, the money flows down to my family trust. Family trust just hold all of like my personal assets, like my primary residence, my car. I don't have any fun toys that I personally own. Oh my gosh, speaking of though, y'all, I've been seeing on Facebook Marketplace this Bronco golf cart, and I keep sending it to mom and dad, and I'm like, Mom, I want this. It's literally like freaking, I've been seeing them anywhere from like 20 to 25,000. I'm like, Hannah, you're not home enough to be enjoying this Bronco golf cart, so chill for a second. So I don't own any fun toys, but if I did, they would be held within the family trust. My family trust does pay my HOA fees, which is pretty cool. But anywho, I'm not going to get into family trust. So money from business trust flows to the family trust, then family trust down to my foundation. Now, my foundation, this is where I have to make a charitable donation every year to satisfy the tax law. So that I can get tax write-offs and deductions for my investment passive income that I'm receiving. And so the requirements, now don't quote me on this, again, I'm still a student, but the requirement is that I got to donate 5% from my foundation to a 501c3 charitable organization. So this is how I'm integrating my policies into my charitable giving through my foundation. So there's one of two things that I can do. One, my policy can be held in the foundation name, and then the foundation can pay the premiums, and the foundation loans can get made payable to it. But how I have it structured is that me, Hannah Kessler, I own my policy directly. I'm that personal owner. And then when I need to take money out and donate it, I will have that loan money get directly deposited into that foundation bank account. So from there, when the money gets deposited into the foundation account, that's how I will go out and give it to whatever charity that I choose. So I will say too, y'all, if you know of 501c3s that are you love, you know the people, they're great, please send them over to me. I'm always looking for more charities to donate money to every single year. This past year I did one to, actually it was one of my close girlfriends. She runs a nonprofit for dogs and training these dogs to help with the elderly or blind people, folks with disabilities or anxiety, depression, mental health stuff. So I was donating some money there, and then also to Maui this past year. So this is how I'm doing it with my policies. Now, I try to funnel every dollar I possibly can through the policies. No, I don't have specific policies that are set up like for specific uses. Like some of y'all do. It just is easier for you mentally to keep organized. Hey, this first policy, this one's for my car purchases. The second one is for saving up for the kids' college education. The third one is for my charitable donation or maybe my Thai money, okay? So I don't do that. I really just look at my policies as they are branch offices of my bank. And so whatever branch office of the bank that I want to go to that day, as long as there's cash value in it, I'm just going to take out the cash values from one of my policies. So now, I'm going to show an example up here on the screen. So for some of my folks, if you're just listening to this auditory, you may want to hop over to the YouTube channel, The Money Multiplier Podcast. And I actually have an example that I'm going to go through. And again, this is for my analytical folks. I know some of y'all like to see these numbers. But here in this example, I am going to put in, let's say, $25,000 a year inside of this policy, and I'm going to only pay these premiums for 10 years. So I put in $25,000 for the 10 years for a total of $250,000 that I'm contributing to the policy. Now, in this example, year 10, I'm going to take out $100,000 and go make a donation to a charity that I love. Now, you don't have to wait until the 10th year to go in there and take out the money, because remember, if this policy is designed properly for the infinite banking concept, you will have cash value that you can take out from it immediately. And my definition of immediately is within 30 days. So if I really wanted to, year 1, I could dip in here and take out cash, this $13,500, and go give it to a charitable organization. So if I wanted to, let's just say that every year I want to take out $13,000 to go give to charity, and let's say I just want to pay it back over the course of that year. So I'm going to take out the 13, let's just call it 13,000 just for easy round numbers. I'm going to take out this 13,000 and then I'm going to go give it to this charity. Now, I'm going to have to do the same thing next year. So I want to play honest banker with myself, pay myself back and charge myself interest. So what I'll do is I'll just pay myself back and with interest, or AKA just look at it as saving back up for next year's charitable donation. So very easy, okay? A question I get a lot is, well, Hannah, what's the terms for the loan that I have to pay back to the insurance company? There's no terms for it. The policy loan is just a prepayment of the death benefit. So you don't have to pay yourself back or even charge yourself interest. The insurance company is never going to ask you when you're going to be paying the money back. So it's just a prepayment of the death benefit. So let's say I want to pay it back just in this first year. I'll take that $13,000 and go give it to charity. And then what I'll do is I'll hop over here to bankrate.com and pick up one of their loan calculators. So if I type in $13,000 inside of my loan amount and I want to pay this back in 1 year or 12 months, and let's say I want to charge myself 5% interest, I do 10%. It's just easier numbers, more aggressive on the interest, more money back inside of my pockets anyways. But it tells me that my monthly payment back to myself needs to be $11,113, so $1,113 a month back to myself for the interest that I'm charging and all the principal. So that means I'm paying back like a total of right around $350 in interest, and $13,000 is the principal amount. So bankrate.com is how I do all of this stuff and how I know how much I need to pay myself back into the policy. And I can be as organized as paying myself back $11.13 every month, or crap, maybe I'll do quarterly payments back to myself, or even semi-annual, just do a big lump sum at it. Or maybe at the end of the year, that's when I get paid a bonus and I'll just pay back a total of that $13,500 back to myself, the interest plus my principal. So this is the freedom, y'all. Some of you guys just get so hung up in needing to be disciplined, or you need somebody. And again, I say that, and you should be disciplined, okay? But it's not like a requirement or like total restrictions that you have to follow. I think some of y'all are just so programmed to just follow what other people are telling you that you kind of lack the imagination and the control that you should have have for yourself, and it's okay to have for yourself. Sometimes I think I just need to tell y'all, hey, chill out. It's fine. You're doing great. You're doing exactly what you should be doing. Even if it's not a on-time monthly payment back to yourself every month, as long as you're paying the 1113 back to yourself monthly, maybe you want to do it quarterly, you're good. Hell, you don't even have to do it if you don't want to. So I think this is my big PSA to tell y'all to chill the F out sometimes, because you are doing fine. And if you ever need to have those honest conversations and blunt dialogue with us, I mean, just call us up. I think last week I did 3 calls where people are just wanting to walk through some questions with me, and they were answering their own damn question, and they just really needed somebody to brain dump on and say, yeah, you're on the right track. You're good. You're fine. So anywho, so this is if I want to, take it out right away and then just start paying myself back right away as well. But in this example, I didn't want to do it year by year because there's just going to be a shitload of numbers up there on the screen. So I'm going to do it in year 10. I'm going to make a donation of $100,000 to my favorite charity. So I pull out this $100,000 from my cash value that's in the policy. And yes, I'm taking out policy loans. The reason I'm taking out loans from the policy is because now I'm never interrupting that compounding interest. Totally opposite from withdrawals. We're not withdrawing the money. We are taking out loans. So essentially, I'm putting my policy up for collateral, and I'm taking a loan from the general fund of the insurance company. So I'm using their $100,000 out here in real life, which then allows my 100 to still grow and compound as if it was never even touched. So what I'll do then is I'm going to take out this $100,000 and I'm going to pay myself back 10% interest over the course of 10 years. So my monthly, or not monthly, but annual, we'll call it. And let me just grab my calculator right here. Let's see what the monthly payment would be. But every year I'm paying myself back $15,852 for this $100,000 for 10 years. So if I take the $15,852 and I divide it by 12, that's about $1,320, we'll call it. $1,320 a month is what I'm paying back to the policy. So I'm paying myself back $1,320 every single month for the whole 20 years. So I put back a total of $158,520. So you can see the total right here at the bottom of the chart, $158,520. So let's just see what happened over the course of these 30 years. Because if you think about it, it doesn't matter if you start your policy today, tomorrow, 10, 15, 20, 30 years down the road, you got to start the system somewhere, somehow. It's almost like, you're questioning yourself, hey, I'm 40 years old. Should I go back to school? Should I pursue this new employment for myself? Well, I'll tell you, what mom told my dad, which I don't know why I think about this a lot, but I do. I just really carry a lot of weight with it. Actually, 2 things I'm thinking of. But the first one, when dad even wanted to go to chiropractic school, he was right around, I want to say 30 or 32 years old. And he says, hey, honey, I would love to be a chiropractor. I want to go to chiropractic school, but I'm just nervous. If I go to chiropractic school right now, it's going to cost me time-wise 4 years. So should I really do this? And mom turns to dad and says, well, Brent, if you don't go to college right now and pursue getting your chiropractic degree, you're still going to be 34, 36 in 4 years from now. So do you want to be 34, 36 with a chiropractic degree, or do you just not want to go at all? So time is going to pass no matter what. Or there's that quote out there. I don't know who originally said it, but I remember in Nelson Nash's live seminars, he would always bring up this quote. But, when's the best time to plant a tree? It was 20 years ago. When's the next best time to plant the tree? Today. And that's why Chris Noggle has his little watch on that he wears a lot, and it literally says now on it. There's no time dial or anything. It just says, when somebody asks him, hey, Chris, what's the time? He says, the time is now. So Let's just see what happened over the course of these 30 years if we just use a policy for charitable giving only. So over the course of the 10 years as my premium deposits, I put in a total of $250,000. So that was my outside premium deposits capitalizing my system. Now, if I'm a good coach, you'll understand that you'll never want to stop paying these premiums, and you'll want to pay as much of it for as long as you can. But just for not having a crap load of numbers up here on the screen, we're just saying that we're stopping premiums after the 10th year. And you can do this, okay? A question I sometimes get is like, hey, Hannah, when can I ever stop paying my premiums? And like I mentioned, if I'm a good coach, you'll understand that you want to pay them for as long as you can. But if you wanted to, you can go in here and stop paying premiums, changing the policy to what's called a reduce paid up. And that option becomes available anywhere from year 7 to year 10, just depending on if the policy will turn into a mech or not. But here we're paying our premiums for 10 years. $250,000 is our net injection into the policy. Plus, for my loans, payments back to myself, charging myself interest, $158,520. So if I take $250 and I add $158,520, that means my net injection is $408,520. Okay, you see that? $408,520. So I put in $408,520. However, I took out $100,000 to go give to charity. That was my donation. So my true net injection is $308,520. Okay, true net injection, $308,520. However, I'm sitting here in the 30th year with $577,000 of cash value in the policy. What? Are you serious right now? 577 of cash value in the policy? You know what else I have? I have the 577 of cash value, but I also have a $1.2 million death benefit that's going to get paid out to my family and heirs when I'm no longer here. So I've literally put in $308,520, and my cash value year 30 is $577. I don't know what it's going to be in year 31, but it's going to be higher than the $577, because you know why? I scream from the freaking rooftops about this all the time. Uninterrupted compounding interest. That's all that's happening here. I'm just never losing out on the interest earned for the life of the policy because I'm taking out these loans. So you can see here by year 30, I'm 69 years old. Next year, I'm going to be 70. Shit, you know what I might be doing now? I might take that 577 and start taking out withdrawals from the policy. No more loans. I could still taking out loans. I mean, I personally probably will because I don't want to surrender part of that death benefit. But what you could do is you can start taking out withdrawals from the policy and start living off of tax-free income for yourself from the policy. So, y'all, this stuff is so freaking powerful. I just want y'all to see, just in this one example of me giving to charity one time $100,000, this is where it's going to be at. So literally from my total repayments back to myself from year 10 to year 19, when I was paying myself back those 10 years. So from year 10 to year 19, I put in the 158, but get this, my cash value literally grew $243,000 with the $158,000 net injection. It grew from 169 to this 413. That's a $243,000 growth with a $158,000 net injection. I mean, this is why I donate to charity this way. I kind of make the joke, hey, Hannah, I shouldn't be getting the money back that I'm donating to charity. That's just not right. God does not want me to get my charitable giving back. Really? Well, if God did not want you to get your charitable giving back, he would not have you press and play on this episode right now, learning how to get all of this money back. And I know this might sound very bold, but do you know any poor people adding on any wings to any churches? Heck, I don't. So I'm just doing the game. I'm just playing this game, what the elite and the wealthy are doing, and I'm just going to mimic what they're doing and playing it right along there with them. So this is just one of the tools, okay? If you are a member of the Money Multiplier, you know that we create the Money Multiplier map, the cash flow analysis, a whole bunch of visual tools to help you use and implement the policy. And we're always updating these tools every single quarter. This is just the free service that we do for all of our members. So this is just one example, okay? I think that's really all I want to get into just for right now. Because I'm looking at my camera. I've been having issues with my camera here recently for some unknown reason. The internal temp of it just keeps getting hot, and I don't know what's going on with it. Maddie's supposed to be coming down here to Florida soon, and she's going to help me with the rest of the podcast studio. So you'll see my new little setup here soon. I'm so excited. So she's going to come down. She's going to help me put it all together and then take a look at my camera. Hopefully I don't have to get a new one. That would suck because I know how to use this one now. But this is just our charitable giving. So check in, okay? If you're a member of the Money Multiplier, check in with your implementation specialist, your mentor, your agent who you spoke with initially to set up your strategy of how to use this, because there's endless possible ways. Y'all, this is just for charitable giving. What if instead of that $100,000 is going to charity? What if that's $100,000 Mercedes-Benz G-Wagon? I don't even know how much they cost. They probably cost more than 100. I think they're like 150, 200, 250. I don't know. But you know, what if I did the same thing instead of it just being charitable giving? It's a Mercedes-Benz G-Wagon. It's literally the same effing thing, y'all. So this is just how I do my charitable giving. So then when I pay myself back, I will the foundation or my active income, like once I start to trickle it down through the 1041 trust structure, that will then go and pay back some of my policy loans. So hopefully this is helpful just to see like a visual on this. Next week, I'm going to get deeper into like estate planning, tax savings. I'm going to bring my 1040 tax guy on the podcast, ask him a few questions, and kind of give y'all some clear direction of how to be using it for tax purposes and protecting the wealth, protecting your assets. Hey, when are trusts a good idea and different things. But I appreciate y'all for being here. Hopefully this was helpful. Hopefully I taught you something new. You learned something, just opening the mindset of different ways you can use the policy. So thank you for being here, everybody. Every week I upload on Tuesdays on all podcasting platforms, the YouTube channel. One thing I think I want to note before I go, here in later on, like in the month of July, in about a month from now, I have an episode coming out with Jason Lowe. We had a really good conversation just about business mindset, but I did ask him a question about, page 48 of Nelson Nash's book, when our income and premium should equal, really what Nelson Nash was talking about there. And so one little nugget or tidbit that I want to leave y'all off with is that a lot of y'all are asking me, well, Hannah, Nelson is telling me that I should be funneling all of my income through the policy because doesn't all of our money have to flow somewhere, right? So I want it to flow through my bank, i.e. the policy, rather than somebody else's bank where they're profiting off of me. But Jason actually really changed my mindset that it's not out of pocket premium to equal income. Really what it is that Nelson's telling us that do not be afraid to capitalize your banking system, because the income from our premium, income to equal premium, is really the amount of money that flows out of the policy, how much is flowing out. Because honestly, if you take it back just to this charitable giving example here, let's just do the math on it. Even though I'm not paying myself back anymore from year 20 and on, so year 20 to year 30, no more outside pocket money is going into my policy, but literally every single year, my cash value keeps growing and growing. Like from year 21, so if I take year 21 cash minus my year 20 cash, if I just take 439, subtract my 426, I put no money into this thing and my cash is growing 13,000 in that year. So literally over $1,000 a month is rolling into me as tax-free monies that I could just withdraw and live off of from the policy. Let's see what happens from year 21 to year 22. I take 453 and I subtract 426. 453. Oh, no, I'm sorry. 453 minus 439. What does that get me? 453 minus 439, $14,000. So because of that uninterrupted compounding, the cash keeps going up more and more every single year. So how I want you to view this is that don't be afraid to capitalize your banking system. Keep maxing out your paid up edition premium. And then from there, how much is rolling in? Think about the policy almost like a passive income investment. How much is rolling in as cash growth that I could take out and start using for my expenses, my investments, my purchases that I'm buying in life. That's really what we're talking about when it comes to income and premium should equal. So anyways, I appreciate y'all. Thanks for tuning in today. I'll be back next week with another episode. I think next week I have my tax guy coming on. I could be wrong. Maddie keeps me organized. Love you, girl. Thanks for always being there for me. But until next week, I'll catch everybody then. Have a wonderful day. Happy Sunday if you are listening to this on a Sunday, or good morning, good afternoon, good evening. Keep kicking butt this week. I appreciate y'all. See you next time. Bye, everybody.